I'm Kyle with Homeowners of Finance, back with my second video in my series on the US housing market. Today, I'll be covering the top 4 reasons why 2023 will not be a repeat of 2008. And at the end, I'll cover what I think a more realistic scenario could be for the US housing market, its impact on the economy in 2023, and what you can do about it if you're a homeowner or prospective buyer. Let's start with a quick 1-minute recap of what caused the 2008 crash. Okay, it started with the US government. They put in place new regulations to make it easier for people to buy homes. Banks were lending money to people for mortgages, but they weren't keeping them on their books and collecting payments on them for 30 years. Instead, they were putting them all together into mortgage bonds and selling them as packages. A lot of these mortgage bonds got AAA safety ratings, even though a lot of the underlying mortgages were riskier subprime loans because historically, you'd never had a whole bunch of people default at the same time, so no one thought it could happen. But the higher return and seemingly low risk offered in these mortgage bonds led to more and more demand from big institutional investors. That drove down lending standards, which the banks were fine with because they weren't holding the mortgages on their books anyway. As long as they didn't default in the first few months, it wasn't their problem. People were getting loans to buy homes with no money down when they didn't even have jobs. Many of the big institutional investors took on a ton of debt to buy even more mortgage bonds than there actually were through derivative products that masked that risk. Rising rates and the worst recession in 80 years caused everyone to have to sell at the same time, and the whole system nearly came crashing down. There's been no shortage of scaremongering pundits out there predicting the next 2008. But now that we have a basic understanding of what caused the 2008 crash, let's dive into the top 4 reasons why 2023 will definitely be different. The first reason I'll cover is that lending standards are much higher and new regulations post-2008 don't allow the banks to take on so much risk as before. To see how lending standards have changed, take a look at this chart where the colors correspond to the labels on the left and the black line corresponds to the ones on the right. You can see from the orange and gray areas that in the mid-2000s, the share of new mortgages going to people with poor or very poor credit scores was over 10%. And more than 1/3 of mortgages were going to people with fair credit or worse. From the black line, you can see that around the time, the average credit ratings of the borrowers dropped down to around 680. As we move over to the right, you can see that in the last few years, borrowers have had substantially higher credit, with scores up in the mid-700s, and almost no one with poor credit getting a loan. In addition, banks are far less leveraged now, and they can't take on the same level of risk that they did in the mid-2000s. The second reason is that there's more fixed rate mortgages and less floating or adjustable rate mortgages. And this means that rising rates will have a much smaller impact on homeowners. When pundits talk about affordability, they're right. For someone trying to buy a home today, if you already bought your home anytime outside the last couple months, you've probably locked in your interest rate for 15 or 30 years at something much lower than today's rate. If you have your rate locked in, which in the US is more than 91% of mortgage holders, it doesn't matter if mortgage rates go to 1,000%. Yours is staying at 3% or whatever you locked it in at, and your payments aren't going to change. To illustrate this impact, take a look at this chart where the orange line is showing us the interest rate for a new mortgage, but the blue line is showing us what people with mortgages are actually paying on average. It's barely budged, but that was not the case in good old 2008. The Fed raised rates by more than 4% from 2004 to 2006, which caused a lot of people to take out adjustable rate mortgages. With an adjustable rate mortgage, you can usually get a lower rate initially, but it only lasts for a few years. And then it will go up or down depending on where interest rates are, meaning your mortgage will get more expensive if rates go up. And that's exactly what happened. You can see here that in the mid-2000s housing bubble, about 1/3 of the new mortgages had adjustable rates. So people were extremely vulnerable when rates kept rising. But for the past 14 years, they've only made up more like 6 to 7% of mortgages, leaving existing mortgage holders much more protected against rising rates. This brings us to reason number 3, which is that most people have a lot more equity in their homes than they did in 2008, meaning they can withstand a fall in prices. Lending practices in the mid-2000s housing bubble were absolutely insane. A lot of the mortgages were interest only, meaning your payment was lower, but you actually weren't paying off your house at all. They also let a lot of people take out loans without putting any money down. So people didn't even own any of the house. They were basically taking on a ton of debt to rent it. But guys, guess what? It gets even better because a lot of the people buying these houses had zero income and no job, which led their loans to be known as ninja loans. No income, no job. And their investments disappeared about as fast as a ninja too. So when people had no job and no income and were buying houses with no money down and adjustable rate interest only loans, it didn't take much for something to go very wrong. And guess what? It did. Rising rates could screw them, falling home values could screw them, losing their job could screw them, if they even had one in the first place. There were a lot of ways for people to no longer be able to pay for their homes. Compare that to today, and it's completely different. We already discussed how much less common adjustable rate mortgages are, so rising interest rates aren't nearly as much of a risk. And from this chart, you can see how in the mid-2000s, looking at the dark green line, the amount of people that had at least 30% equity in their home, meaning they owned at least 30% of it, plummeted from more than 45% to less than 30%. While the people who own less than 10% of their home, which is the orange line, skyrocketed from 15% to more than 35%. Worse yet is that most of these people, more than 20% of all outstanding loans at one point in 2006, had less than 3% equity in their homes. Fast forward to today, and you can see that as of the end of 2021, the amount of people with more than 30% equity in their homes was about as high as it's been in the last 25 years. And the amount of people with less than 10% and less than 3% were near their lowest points. And these numbers are from the end of 2021. We know home prices have gone up a lot in 2022. So actually these numbers are probably a little bit better than what I'm showing here. That means that unlike the period leading up to 2008, most people have not taken on too much debt and are not at risk of being forced to sell their homes at a huge loss if prices fall a bit. Reason number 4, and probably the biggest one of all, is that a lot of the compounding effects that really turned 2008 into what it was are no longer there. It wasn't just the fact that a lot of people took on too much debt and lost their homes that turned 2008 into a global financial crisis. It was also all the ways that the rest of the economy turned out to be dependent on housing. All right, guys, so let me give you an example. Remember the GameStop frenzy and the crypto frenzy? Well, imagine that with housing. That's what housing was like in 2008, 2009. Everyone thought they were a real estate expert. A 2-second Google search came up with this perfect example. Hey, at least you had another income stream. But a key difference between 2008 and 2023 is that in the mid-2000s, about 1/4 of the new jobs created in the US economy were related to housing. That meant that not only did people lose value on their homes when the market crashed, but a lot of them also lost their jobs. Countrywide alone, which was the largest mortgage lender at the time, employed 60,000 people. And it didn't just stop at the housing-related jobs either though. It spread to the entire financial sector. A lot of big banks got caught up in the crisis, so they laid off thousands of people. Then all these job losses, huge debts, and lost homes meant people didn't have any money to spend. So the economy and the stock market took a nosedive. When no one else could spend any money, a crisis that started with housing spread to every sector, and it spiraled out of control until the Fed and the Treasury Secretary stepped in to save the global economy. If you haven't seen the documentary Hank, 5 Years from the Brink, it's the story of how the economy was saved, and I highly recommend it. So I do not think that 2023 will be a repeat of 2008, but I do think that home prices will fall and we'll have a recession. The main reason I think house prices will fall, but not drastically, is because in addition to no one wanting to buy, no one wants to sell. That push and pull of low demand, but also low supply, should help cushion prices, and a lot of the exacerbating factors like huge housing related job losses, adjustable rate mortgages, and questionable lending practices that led to massive forced selling in 2008 are just not in place this time. When it comes to the economy, it's all about inflation and interest rates right now, and housing is an important component of that through owner's equivalent rent. If house prices come down, that will help inflation come down. And if inflation comes down, that means the Fed doesn't have to raise rates as much. So that could help us get back on track. Economic models aren't perfect, but for what it's worth, the Dallas Fed's model estimates that owner's equivalent rent inflation lags behind the annual change in home prices by about 1 to 1.5 years, which suggests that owner's equivalent rent inflation could peak in spring or summer of 2023 and then start falling from there. I don't have a crystal ball, but to me, that sounds like a scenario where house prices could fall a bit, but probably not enough to crash the economy, which could then lead the Fed to pause its rate increases at some point in 2023. So with house prices down a bit and rates no longer rising, housing affordability gets slightly better, and we probably have a fairly standard recession and recovery. Housing is an important component of inflation, but we can't ignore the others because they're all tied together. All that pandemic stimulus and Biden's massive spending plans have also been huge drivers of higher inflation, and it's been exacerbated by higher food and energy prices from the war in Ukraine. So beyond house prices, changes in any of those things could alter the course of inflation, and thus alter the course of rates, home affordability, the economy, and the stock market. But given the situation we find ourselves in now, the Fed has been raising rates to curb inflation. They are likely to continue to do so for at least a few more months, and that's ultimately why I think we're likely to have a recession. Higher interest rates make it more expensive to borrow, and eventually the economy slows down, which is what hits inflation. We're in the middle of this already, and while all recessions suck, I don't see any reason to believe this is going to be anything like 2008. Some people will lose their jobs, but not as many. Home prices will likely fall, but that's pretty normal in a recession and a rising rate environment. And I think the main reasons why that led to a broader and deeper crisis in 2008 are simply no longer present. Oh, and one quick bonus comment about the stock market, since that's the normal focus of this channel. I'm probably gonna wait a bit on this one, but at some point, the home builders are gonna be a very interesting buy because they're getting very cheap, and most of them are pretty unlikely to go out of business. Maybe I'll do a video on those in the next few months. But back to the main topic. So what would I say to homeowners and prospective buyers right now? Don't upend your life because of your expectations about the real estate market. As a buyer, I would wait if possible. But if you're buying a home with your spouse because you just got married, or buying a house in a new city because you just got a new job there, I want to discourage you from just buying a home anyway. Remember, you can most likely refinance your mortgage a few years down the road if interest rates are lower. If you're a homeowner right now and thinking about selling because prices are going to fall, I don't think that's a good idea unless you think prices are going to fall a ton in your market and you have another good place to live. Here are 2 reasons why. First, most people are going to be totally fine in the 10 to 20% drop scenario that the majority of experts are projecting. For a simple example, let's say you bought a house 2 years ago, put 20% down, and it went up in value a bit, so now you've got more equity in your home. Maybe it's a $500,000 home and you owe $325,000 on it. This is an overly conservative estimate, by the way, because with average price rises, it would actually be worth more like $600,000 now. But let's call it $500,000. If the value of your home falls 10%, you're fine. You owe $325,000 on a $450,000 house. If it falls 20%, you're still fine. You owe $325,000 on a $400,000 house. Given how much prices have risen, most people have plenty of equity in their home to stay in the green, even if prices fall 10 to 20%. And second, to me, the math just doesn't check out to sell and go rent an apartment if you're expecting a 10 to 20% decline. Think about it. The seller pays the realtor fees for the buyer and the seller, which is usually a total of 6% of the value of the home. Then, if you're not reinvesting in another primary residence, you also might have to pay taxes on your gains. If that's the case, it could easily cost you more than 10% of the value of your home right there. Then you've got moving expenses, maybe you have to rent another place, and rents are also way up, so you might be making similar monthly payments, but having nothing go to principal anymore. Trust me, I've moved enough times to know that's a hassle, and depending on your tax situation, it might just be better and easier to stay put and see what happens. Well, thank you so much for watching, and if you want to know the 9 habits you need to be a successful investor, check out the link below in the description. I will see you in the next video.